Hi, welcome everyone to our webinar on employee incentive schemes, alternatives to startup concessions. My name is Helen and I'm a practice leader in LegalVision's corporate and tax team. I'm joined today by Jack Chi, who is an accountant at William Buck. Before we begin, hi, welcome Jack. Before we begin, a couple of quick housekeeping items. Now you'll receive the recording and slides in your email. Please submit your questions in the chat box and we'll answer them at the end. Please also complete the feedback survey after the webinar. Also, all attendees are eligible to receive a complimentary consultation with us to discuss how we can help you with your contracts and legal needs. To request your free consultation, please provide your contact details at the end of the webinar. So today we'll be discussing the points that are on the slide there. We'll start with what is an employee share scheme and the fundamentals, a few pointers on the startup concessions that some of you may already be aware of, and when do you actually need to start thinking about alternative schemes, which is why you're here today. And we'll go through the top 6 that we've seen commonly. At the end of the webinar, we'll be answering some of your questions, so please submit your questions at the end. Throughout the webinar, you'll see a chat function come up and we'll answer them at the end. So moving to the first slide, as mentioned, I wanted to cover through, employee share scheme fundamentals. Why would you even have an employee share scheme in the first place? Employee share schemes are becoming a very common and popular alternative way to incentivize and retain staff. We've seen them becoming a very popular mechanism with startups, particularly because employers are trying to employ key employees and staff without having to compete with larger and more established businesses with more competitive salaries. As businesses grow larger and they're moving out of the startup phase, employee share schemes are still essential because a lot of employees that we've seen want to be part of the business. They want to have a sense of ownership and working together as a team towards certain goals, such as a buyout in the future or an IPO. These are all reasons why an employee share scheme is quite fundamental in a business. Now, there are also tax implications when thinking about employee share schemes. It is important to consider these, particularly because there's a provision within the Tax Act, which is under Division 83A. Now, this provision basically provides that if you're providing any equity to your employees, whether it's shares or options or any rights, then that equity could be taxed to the employee. Now, that provision is very broad, and any arrangements between the employer and employee could be deemed employee share scheme under these rules, and the tax implications within that provision would apply. It is important to note that the definition of employee is very broad, and it can capture contractors, directors, and individuals that are providing services to the company. So it is important that you seek advice when setting up an employee share scheme. Now, there are startup concessions concessions that are available to certain startups if you meet certain conditions that may be very helpful when setting up an employee share scheme. Jack's going to go through these concessions and how they can be of benefit to the company or to an employer. Thanks, Jack.
Okay, next slide. Okay, thanks, Helen. And you're a real trooper to do this while your voice is like that. I've always wondered what it's like to be a rock star or a singer like that and have anxieties about your voice just before a concert. Thanks. All right, so before I begin, everyone, I like to emphasize the usual disclaimer about none of this is tailored tax advice. These are general comments only and should not be used as tailored tax advice. Okay, so all right, so before getting to the alternatives to startup concession, I'll quickly talk about the benefits and the conditions of startup concession. Okay, so why has startup concession made such a big splash in the Australian tech space? Well, it's because vast majority of the time it is the go-to as far as employee share schemes are concerned for startups from a tax standpoint. Okay, it's highly concessional because It's excellent from a timing perspective and excellent from the amount of tax standpoint. Okay, so eligible startup concession schemes for the participant, there is no tax upon the issue of the ESS interest. There's no tax upon vesting. There's no tax upon exercise if it's share options. All right. So rather, the tax is payable at the time of the disposal of the shares or the options, and the entire gain is taxed on capital account, i.e., subject to the 50% general CGT discount if the shares or options have been held for at least 12 months. And the amount of time that the participant has spent as option holder still counts towards the 12-month minimum holding period, even if they turn the options into shares and they sell the shares. Okay, so these benefits are real, and this is why startups are very keen to get it, and why founders can sometimes panic if they're about to fall out of eligibility for the startup concession. Now, we won't go into the details of the conditions of startup concession today. More info will be circulated subsequent to the webinar, but essentially what we're saying right now is if you recall this startup concession being something that was introduced under the Turnbull government effective from July 2015, well, a lot of time has passed, and what causes a lot of startups to be ineligible for the startup concession is the 10-year limit on the company's age, right? So some startups, if it's just one company, they may be approaching or exceeded the 10-year limit. If it's a group of companies, sometimes they have companies that come and go, and if there is a company in the group that is older than 10 years for whatever reason, for example, it's an acquired company, then you could have an eligibility problem. So the 10-year limit is a real common reason why people fall out of the startup concession. There's another example that we see from time to time is when the $50 million aggregated turnover limit has been breached. Okay, so clearly that's quite a high limit, and these conditions are there because what the government regards as what constitutes a startup. We won't get into whether we agree or disagree, but essentially the government has set parameters, and these are kind of parameters that causes issues. And there's also a 10% equity limit at the participant level, where they're just simply not eligible for startup concession. They've breached that limit. The policy rationale behind that is that the government, when they introduced this law, they wanted this to be a mechanism to basically help non-founder ESS participants. Okay, so some of what we're talking about today are also applicable to these kind of founders that are seeking to set up ESS for themselves, although not all of them are suitable for founders. Okay, all right, next slide, please. So these are the top 6 alternative schemes to the startup concession. Now, this is not exhaustive. Okay, so there are other schemes out there. There's all sorts of weird and wonderful schemes. For example, there's flower and shares that we just don't have the time to talk about. But the 6 we're going to talk about is number 1, there's upfront taxation schemes. There's tax deferred share options. There's limited recourse loan share plans, indeterminate rights, premium option plan, or also known as POP, quite a catchy name. And finally, phantom share schemes, which is a bit of a misnomer because it's not a real share scheme, as you will see. So which one of these is appropriate? Yeah, it really depends on the company, what the company is trying to achieve, what its circumstances are, what has been agreed between the companies and the participants. Okay, so there's no one scheme that fits everyone. So the purpose today is to help you understand some of the high-level issues, so you can take that away and help with your decision making. Okay, next slide, please. All right, so the first one is upfront taxation, share or option scheme. Now, if you don't pay any attention to how the employee share scheme is set up, then the starting point may well be that participants get taxed upfront, okay, on the discount that they receive in relation to the shares or options relating to their employment. Now, this is clearly a problem for vast majority of cases, given that, you know, the one thing that you want to avoid is there being a tax liability when there is no liquidity, well before any kind of cash is received by the participant, and well before we know whether the company is going to be a success or not. You know, a lot of the time. However, this could actually work out quite well for shares options that have really low market value, but you expect this market value to rise quite dramatically later on. Now, if you're gonna try to adopt this position, then make sure that there needs to be a strong position supporting why these shares options have low market value, and therefore the tax applicable to participants is minimal or immaterial. Okay, so just simply a few lines here and there may not be enough. Oh, well, it will not be enough actually. Okay, so this is the starting point if you don't do anything at all, and it could work for certain situations. Next slide, please. Now, number two, there's tax deferred share options, where the taxing point is deferred until the earlier of the first year that the employee is able to dispose of the share options. Generally speaking, this is when there is no real risk of forfeiture, and there are also no disposal restrictions. Okay, so the rationale behind this is that if the employee is able to dispose of them, then you know, in theory, they could service the tax debt. But of course, in reality, this may not be the case, simply because unlisted shares, even if the employee is in theory able to dispose of the shares or options, it doesn't mean they actually could practically if there is no liquid market for the shares or options. Okay, so that's the first potential deferred taxing point. And the second one is 15 years after the issue of the options. This means that the taxing point cannot be deferred beyond that. Okay, so the tax is deferred to the earlier of these 2 points in time. So the assessable amount, that will be just calculated as market value of their options at the deferred taxing point, less any amount paid by the employees to acquire the options, which generally speaking is zero. Okay, so if you use these deferred options, there is the opportunity to structure this the scheme so that tax is deferred until you know, after a certain period of time has elapsed, or a specific event such as a capital raise or exit event. Exit is quite common, what I most commonly see, but you do need to think through how the clauses are written so that you actually get the result that you want. A disadvantage of these tax deferred options is that the upside that the employee gets is mostly, if not entirely, taxed under the marginal personal tax rates, as opposed to the capital gains tax regime, where there is a potential 50% capital gains tax discount for assets held more than 12 months. Next slide, please. So number three, limited recourse loan share plan. Now, I'm sure a lot of you have heard of something like this. There's other names for it, for example, just simply loan share plan, all right? So under such a scheme, the employee buys the shares in the company at full market value, okay? So there is no discount, so which means that there is no tax upon acquisition. So it's very important that you can justify the market value and that is being used to for these shares to be acquired, because that's the key basis for arguing why there is no taxable amount, okay? Why there is no discount and therefore no tax at issue time. Although the employee is buying the shares, he or she does not actually need to reach into their pocket to buy the shares. There is a loan funded from the employer. What this does is effectively replicates the economic substance of a share option, i.e. the participants participate on the future upside in the capital value of the shares. It's called a limited recourse loan is because there's essentially no risk of the employees losing anything other than the shares themselves, so they only get the upside. So if, for example, the shares are underwater, if they're worth less than the liability itself, they can just walk away, right? And the company will have no recourse to chase the employee for the shares. And other features of such a scheme is loan is usually repayable upon the future sale of shares, and you can have after-tax dividends applied against the loan. But since it's tech companies we're talking about a lot of the time, this isn't really applicable. Okay, but you can still have such a clause in there. All right, next slide, please. So I often get asked, what's the difference between a limited recourse loan plan versus a tax deferred scheme, the pros and cons, right? So the advantages of a loan share plans are you only pay tax once, i.e. upon the sale of the shares, okay? There is any gain on the sale is on capital account. Therefore, shares held more than 12 months, you could get the 50% CGT discount, depending on obviously the type of the taxpayer. So the discount is not available for companies. It's only applicable to individuals and trusts. And there is no cash flow burden as the liability is connected to a liquidity event usually. And although there is initial loan liability, the overall upside to the employee on an after-tax basis may be higher than a tax-deferred scheme if the value of shares has significantly increased. Okay, so what this is saying is, yes, sure, there is a liability for the loan, but the amount of tax saved is much higher. Okay, so obviously this doesn't apply to everybody. Really depends on how the numbers worked out, but it could definitely work out this way. Now, the disadvantages of a loan share scheme. So like I've already touched on, there's an existence of a loan liability. So in theory, on day one, there is no upside, and this upside to the employees only accrue over time. And also this loan liability sometimes worries people. A lot of devs, a lot of engineers, they're not from a financial background, so they don't know these things. And depending on the level of trust involved, they may not like the idea of owing a loan, okay? Another disadvantage is employees, they become shareholders from day one, which means that they could get rights to voting, dividends, and financial information. But it is possible to obviously issue different class of shares that provide no voting or dividends rights. Another disadvantage is not the loan share plan doesn't work so great for existing shareholders, okay? And it's difficult to issue multiple tranches of shares. The reason is that this is tax division called Division 7A, which limits what a company is able to loan to its shareholders. Although there is a workaround if the company has carried forward retained losses, and if it's able to argue that there's no distributable surplus. Okay, so we won't go into details of what distributable surplus is, but this argument could fly if the company has never made a profit. All right, so definitely get tax advice on that. There are personal tax issues in a buyback and cancellation scenario where there's a bad leaver situation. Okay, and finally, what is common is for people to get their related family trust to hold employee share schemes. Well, this is going to be difficult under the limited recourse loan plan because of FBT reasons. We won't go into details of why, but just have that as an issue that is on your radar. Generally speaking, these loan share plans, the shares are held in the employee's name only. Okay.
Can I
right.
jump in,
Yeah.
Jack? I just wanted to add with the share buyback, just from a corporate perspective, the share buyback process can be quite onerous, and it can be a bit of a process because you have to give notice to ASIC and also have a shareholders meeting, and also the notice has to be 21 days in advance. So the share buyback process can be a lot of work as well. And so if you're offering a limited recourse loan arrangement to a number of employees, and there's a chance that some of them there's a risk that they might be leaving, then there could be a lot of share buybacks, which is a lot of administrative burden on the company as well. And as well, Jack, I just wanted to ask, the first point you made with the disadvantages, the existence of a loan liability. In your experience, have you seen, I guess, clients, they've entered into these arrangements where the loan itself has implicated them on a borrowing capacity, like from the bank's perspective, having this kind of liability on their books from an accounting perspective?
I have not seen it because in theory, the bank should understand that what the loans are about, i.e. this limited recourse aspect, okay? But it could cause questions. You know, there's an argument that, you know, how do they even know? You know, they may find out, and secondly, they do find out, in theory, they should be able to understand this is limited recourse. But, you know, with Australian banks, that way they are so risk averse, you never know for sure, but I've never actually personally seen this causing an issue from a, you know, person trying to access a mortgage to buy a house standpoint. But now that you raised this, Helen, like, I just want to add that, you know, the limited recourse loan is not a potential, it might not be a good solution where there's been some kind of an existing agreement between the company and the employee that he or she is going to get shares for no consideration at all, i.e. shares for nothing situation. This is not what limited recourse loan is about. It's all about future upside.
Yeah, thanks for that, Jack.
Okay, all right, next slide. Indeterminate rights. I think that's
me.
Yeah, that's you. Yeah. I'm too overexcited, Helen. I was about to take this slide.
This is a very exciting scheme, so I can understand, Jack. So indeterminate rights. This one's interesting. It's essentially a scheme where you are issuing a right to employees to receive something in the future, and that something or that benefit is indeterminate at the time of issue. Because it's indeterminate, because you're either going to receive cash in the future time or potentially shares, there is a provision within 83A which says that there is no tax at the issuance time. The benefit, or I guess what happens then in the future time, is if equity is issued to the employee in the future time, then the employee needs to go back to the original year they had received the right and amend their tax return to show that as if they have always held those shares right from year one or from the year of issuance. If the right provides the employee with cash at that future time, then that employee needs to go back. Oh, no, sorry, no, not go back. The employee just receives the cash as if it's a bonus and treat it as ordinary income. PRYG is withheld on the amount that's paid to the employee, and also superannuation would need to be paid as well. Essentially treated as like a bonus. I guess the pros in these types of schemes is that there is no tax payable to by the employee at the time of issuance. These types of schemes can be beneficial for arrangements where you want to incentivize your employees, but you're unsure as to whether you do want to give them equity in some future time, or whether you just want to give them a payout. And it does mean that the employee is not burdened with a tax liability at the time of issue. It does mean that they have to go back and amend their tax return. There is questionable as to whether the ATO would impose penalties or interest because of a late or amended lodgement, but we haven't seen that in our experience where the ATO has imposed that. Some of the cons in this type of scheme is that it is important that these structures are drafted correctly, because in the event the ATO deems this to be not an indeterminate right, but actually just a taxed upfront scheme, the first one which Jack spoke about, then the employee would just be taxed upfront. And there is also inherent uncertainty as to what the employee is going to receive. So the employee may actually not be wanting to enter into this type of scheme because they themselves don't know what they're going to receive in the future. The last point is the 50% CGT discount. As Jack mentioned, this is something to consider is when you're disposing of your shares, you may get the 50% discount, provided you've held the shares for more than 12 months. If at the time you receive the equity in the future time, you may only hold those shares for a period that's not 12 months before they're sold under an exit event, which means the discount won't apply to the employee. Just something to consider when implementing these types of schemes. I've moved to the next slide, thank you. So the next one here is the premium priced option plan, also called a POP, as Jack mentioned. Essentially, these are an employee share option plan where the exercise price is sufficiently above the market value of the shares at the time of issue. If certain conditions are met, then the options could have a nil market value at the time of issuance, which means that there is no discount for the employee and therefore no tax or no amount accessible to the employee and no tax payable by the employee at the time of issuance. Obviously, whether it has nil market value is going to come back to a valuation question. There are generally two ways options can be valued. The first one is just a valuation determined by a valuer. This may not be an option you want to consider if engaging a valuer can be quite expensive. So then there is a second option, which is valuing under a statutory method that's provided under the regulations. Although I should note that you still need a valuation to actually apply this method. So it's just weighing up those costs and the processes. Now this method, the statutory method under the regulations, looks to various types of inputs to determine the value of the options, and it looks to what the exercise price is and also how long the exercise period is, up to 15 years. Generally, the way it works is that the higher the exercise price above the market value of the underlying shares at the time provides a lower option value, and if the longer the exercise period, then there's a higher option value. So we've just put there on the slide a table which gives some examples of how this formula works. It is important that you either go through this table and the regulations or get your accountant to assist with this, because it can be complicated in applying this table and you don't want to get it wrong. So if we move to the next slide. I've just listed here some pros and cons in putting in place a premium option plan, because it may sound like a great idea, but we have to consider what are the cons as well. So obviously one of the key reasons why people do put in place a premium option plan is that it can be structured in a way where there is no tax payable at the time of issue. And in most cases, when employers are considering what type of scheme to put in place, tax is number one. They don't want their employees to be paying any tax on at the time of receiving rights or options or shares. So this is why this type of plan is one of the top six, really. As in point two, I've just noted there that because the employee is receiving options, they don't become a shareholder until the options exercised. And a lot of clients I work with, they don't want to be providing equity to the employees for voting or distribution reasons. So this plan might be appropriate in those scenarios. There's also something to consider if you're wanting your employees to buy in. So rather than receiving equity for nothing, there are cases where, and I come across a few of these clients where they do want employees to feel like they've contributed towards the scheme itself and they're actually invested by paying something. This scheme requires them to pay a premium price to actually exercise and receive the shares. So that's another pro. So some of the cons, as I mentioned earlier, you still need to get a market valuation to apply the statutory method. Whether you engage a valuer or get your accountant, someone like Jack, to speak to you about valuations and how that works, or whether you do it yourself, there are certain guidelines the ATO has. So it's just important that you justify the valuation that you're putting in place and applying towards this method. The second point that I've got here is that the employee has to come up with the actual cash to exercise. Now, for some employees, the cash could be significant and they don't have the money. So where are they going to come up with that? It limits those types of employees that do want to exercise. There are certain workarounds that we've seen before where the company or the employer may pay out a bonus to employees and obviously take into account the tax they'll have to pay on that bonus to account for that exercise price. Another way is potentially the company loans the money, noting there could be fringe benefit tax implications in this loan until there's an exit event where there's a payout. So it's important that when you're setting up these kind of schemes that you're getting advice, whether it's from your accountant or your lawyers, to make sure that you're working through the outcomes and kind of these implications. And the third point is just the 50% CGT discount again, because shares most often are exercised, the options are generally exercised just before an exit event, which means that the employee has not held their shares for more than 12 months. So it's just something else to consider, but there are sometimes ways to work around this as well. So we'll move on to the next slide, thank you. So the last scheme I wanted to raise is the phantom share scheme. Now, Jack did mention that this isn't really, I guess, an equity scheme because no equity is actually issued to the employee. It's essentially a bonus scheme that mimics the benefits of real shares without the employee being a shareholder, which is hence the name of phantom share scheme. They also are called shadow share schemes as well. It's most times in the way we've seen these is that they're structured around certain KPIs or profit milestones tied to the dividends that are paid out to the real shareholders or tied to an exit event. So if there's a share sale in the future or a business sale in the future, the phantom shareholder would receive the payout based on the number of phantom shares that they hold at the time of when they were issued. So it does give employees a sense of, I guess, ownership in the way that they will get something if the company grows or if there's a buyout in the future. And also if there is a dividend payout, they will also get a payout as well. Noting that those payouts, because they don't actually hold shares, the payout is actually just an income tax payout, as if they were being paid a bonus, and it'll be treated as income tax. As opposed to as income tax and won't receive any franking credits that would be attached to dividends normally when they're paid out to a real shareholder. So when paying out dividends or payouts to these phantom shareholders, there still needs to be PRYG withheld and also superannuation on those amounts, which can actually be, I guess, a burden on the company as well, because they still need to consider the employment taxes that are involved on these payouts and potentially, a liability to the company because they need to come up with the cash, which is one of the cons I should probably move to. So if we move to the pros and cons, as I mentioned, the company has to pay out the liability to the company. So if there was a share sale in the future, the company will need to come up with the cash to actually pay out these phantom shareholders, whereas the real shareholders are receiving the proceeds from the buyers of the shares. So it can become complicated at that point where the company needs to put aside money for these kind of events. So I'm just moving upwards from the cons. As I mentioned earlier, the employees must pay income tax on the payouts being paid to them under a phantom share scheme. Because they're actually not holding any shares, there's no no capital gains tax benefits such as the discounts or concessions that might be available to a real shareholder. And the first point under the cons is the employees do not have any ownership in the company. So that is an important factor, particularly if you're one of the key reasons you may be implementing a scheme is for ownership. But as I mentioned, you could market it in a certain way, whereas you are still tying it back to the company dividends and also exits. A couple of pros I've just mentioned there is that because it's not real shares, you don't have to deal with the Corporations Act or shareholder agreements. It is easier to implement because you don't have to deal with the Corporations Act, and also the tax implications. We don't have to deal with 83A because you're not actually giving these employees any equity. So it is simpler to implement and easier to administer. We have seen these quite commonly implemented for companies that are cross-border that want to implement, provide schemes or an incentive to employees in various different countries, because having various different schemes in different countries can become quite complicated and onerous. The employer, we've seen in our case, you need to get advice in various different countries, and it becomes very expensive. So this is a scheme that is quite common that we've seen. So we're moving on to the next slide. We just want to finish up with, things to watch out for when thinking about what kind of scheme you want. As Jack mentioned, we do see a lot of founders trying to access the startup concession under the 83A. And this is why, because a founder already holds shares, in most instances we see founders holding 50%, and because they hold more than 10%, they are not going to be eligible for the startup concession and therefore need to start looking at these alternative schemes. The second point there is that, so promises made but not action later. So what we see is a lot of our clients, they talk to the employees, promise them certain equity, or say we'll give you ownership of the company, but nothing happens until potentially a year later. This is really important because when you actually making a promise and actually issuing equity has different implications for tax purposes in regards to the timing as to when the employee is receiving the equity, and then what is the market value of the equity at that time. The market value is not at the time of when the promise was made, but at the time was when the equity was actually issued. So promising something but not actually doing anything with that promise can have huge implications for the employee. The third point there I've got is payroll tax. Now, some of you may already know this, but an employee share scheme, employee share interest or equity or shares being issued to employees are deemed to be taxable wages for payroll tax purposes, and the market value of the equity that's been given to the employee is used to add towards that taxable wages when calculating your liability for payroll tax. This is really important and is something you need to keep track of, particularly if you're really close to the threshold in your state. And it can become quite complicated as well if you've got employees in a number of different states. So yeah, just something to look out for. The last point there I've got is annual ATO reporting. There is, under all these schemes, other than the limited recourse and the phantom share scheme, anytime you're issuing equity, you need to be aware that you need to report this to the ATO. There is a time period as to when you need to do this. It's the 14th of August of each year of the following year. Just something to remember to do if you're entering into some of these equity schemes. If you move to the next slide, we wanted to just raise some considerations to think about when you're actually considering what kind of scheme do I want to put in place. Now, the first one is really important. As you may have seen, we've highlighted both parties, the employer and employees, should obtain tax advice. Each scheme has its different tax implications, and each one has different pros and cons. They're all very different, so it's really important you obtain advice before implementing a scheme, which does go into the second one, which is one scheme doesn't fit every scenario. Some clients have multiple schemes in place for different employees or different types of, different key employees that they want to incentivize. Just because your friend down the road has the limited loan recourse doesn't mean that that's appropriate for your business. It's really important that your circumstances are discussed with your advisors as to which one's appropriate, which then goes on to the third point, which is, why are you even wanting to incentivize your employees in the first place? This is really important. You need to think about, why are you doing this? What are you trying to achieve? What is your exit strategy? And do you want these employees to be shareholders or not? They're all kind of key points that you need to discuss with your advisors to actually come to which scheme is more appropriate for what am I trying to achieve. So the fourth point is, what is the income tax on and CGT implications on disposing of the asset? As we've highlighted throughout the webinar, the 50% CGT discount is quite significant and can be impacted depending on the scheme that you implement. So it's just something to remember and consider. And then the next point is considering employment taxes and deductibility of cash payments. These are just something else you need to keep in mind as well. And then the types of good and bad leaver provisions that are within that scheme. How do you actually deal with that employee in that scheme if they were to leave on good or bad terms? The last point here is exit events and milestones, how you tie them into the scheme, and also, I guess, the way it's going to actually happen within the scheme itself. This is important. It kind of ties back in with point 3 as being a discussion you would have with your advisors. So that's the end of the webinar as the kind of last point. Just moving to the next slide there. Just finishing off. So we're just going to answer some of your questions shortly, but while you're submitting them, we'll just take a minute to tell you about our membership. Now, LegalVision's membership is a cost-effective alternative to, I just note there, there's a slide there just about a publication that we'll send out to everyone as well, which you can also find just by scanning the code that's on your screen. So thanks for that. And just wanted to note there is an upcoming webinar that we have as well, which if you could join us for, which is how founders can succeed in the startup ecosystem. That's on Thursday, 30th of November at 10 a.m. So as I mentioned, we're just going to go through, I guess, some of the benefits of our membership as well. As I mentioned, it's a cost-effective alternative to the hourly rate experience that you generally have with other law firms. For an affordable monthly fee, you will receive cost certainty and an all-inclusive legal services, including unlimited document reviews, drafting, amending, and reviewing, unlimited advice consultations. We have a team of more than 100 specialist lawyers, which includes business structuring, employment disputes, and more. We also provide unlimited domestic trademark registration. Now, as a LegalVision member, you won't worry about the cost of lawyers ever again. Think of it as having your own in-house counsel. We'll take care of all the business as usual legal work, so you can really focus on running your business. Now, if you are an in-house counsel, our membership is a cost-effective solution for outsourcing additional legal work. To learn more about our membership and how it can help you, please request a free consultation you'll see on the survey, which appears at the end of this webinar. So on the next slide, we just have Jack's contact details and also a QR code there. So please reach out to Jack. He's very experienced in accounting queries and startups, and someone that I turn to a lot actually for a lot of queries, particularly in the employee share scheme space.
Thanks, Helen. Always a pleasure.
Yeah, no, thanks. So there's his details there if you want to get in touch. We do have a few questions that have come up. I think, Jack, if you wanted to go through some of the ones that we've got a few.
Okay, cool. Yeah, and I think we can just pick out some of the questions, and we'll just answer them as quickly as we can, because there's a fair few, right? So
yeah, we're running out of time, so we'll pick up the good ones.
Yeah. So they're all good questions, and if we don't get around to your question, feel free to reach out afterwards. Happy to give some pointers. Okay, so can I use the loan scheme plan if I'm a founder of the business? So we've touched on the difficulties where the participant is an existing shareholder of the business, but at the same time, there is a potential way around it in the form of arguing there is no distributable surplus. It's quite a technical solution, so definitely get tax advice on that. But generally speaking, problematic. Okay. So can I still use the ATO safe harbor valuation method to value my shares for the other schemes? Absolutely not. Okay, so do not use that. ATO will not accept it. A lot of the time is the commercial definition of market value. Practically, what people use is a recent cap raise, provided that it's not too far away from the share issue time. Okay, that's what I see a lot of the time, and also stay well away from anything that purports to give you a valuation under the 409A valuation schemes. That's a US concept. Okay, so US law has zero application in Australia. Okay, I have to convince people why 409A valuation cannot be used, and it's the amount of myth and wrong information out there is actually quite scary.
Jack, I just want to let everyone know that's still on. We are over time, but we're going to extend this by a little bit longer just to accommodate the number of Q&As that have come through. If you can't stay, don't stress about it. We'll send out the complimentary, we'll send out this webinar in a few days, and you'll also get a handout as well. And if you have any more questions or want to discuss with either Jack or myself, just reach out for the complimentary consultation. We love talking about alternative schemes and employee share schemes. So yeah, happy to have a chat with anyone if they want to go through anything further. But sorry, Jack, continue with the question.
Yeah, just trying to answer as many questions as possible. So what if I already have a startup ESOP plan in place already? When do I need to start thinking about these alternative schemes? So the answer is you want to have these schemes, at least the documents in place before you fall out of the startup concession. Okay. So what type of scheme should I put in place if I want to incentivize a lot of employees, for example, 100 employees? So you'd want to be careful to have too many participants. Clearly, big companies will have a lot of participants, and if you are a big company that's thinking of this, then that's perfectly normal. You will be able to get the advice and have the infrastructure to put something like this. So a lot of these schemes will be okay with a lot of employees. Okay, so there are Corporations Act considerations when you have so many employees. You get into reporting entity territory there, obviously, with more than 100 shareholders, unless it's options you're talking about. Okay, how do I set up a share scheme for overseas employees?
Well, sorry, Jack, can I just off that one question with 100 employees? We have seen clients put in place like bear trust arrangements or employee share trust to deal with the number of employees where they just want to incentivize hundreds or thousands. I spoke to someone the other day who wanted to incentivize 1,000 employees. So as you mentioned, I completely agree. It's very onerous from an administrative perspective. So thinking about how you actually do this requires a lot of planning. We also work quite closely with Cake as well. They also administer a lot of these types of large schemes where there's just a lot of admin. So it is doable, but you need to plan it.
Yeah.
Sorry, Jack.
Yeah, all good. Yeah, you just have to get plenty of advice on that one. How do I set up a scheme for employees overseas? Look, a lot of the time, startups take the easy route of essentially using the same documents, same share plan for overseas employees, but you need to make sure that they get their personal tax advice from their overseas accountant because their tax implications differ. Okay. with the loan plan, what if our employee leaves before an exit? Do they still need to repay the full loan? So this is actually quite a long answer. It really depends on things like your good and bad leave provisions, whether you allow this person to retain their shareholding. Okay, many startups do not. Okay, many startups force employees to sell when they leave, but although obviously it's still possible for you to allow the employee to keep the shares if they're a good leaver. Okay, but if they dispose of the shares, then obviously the loan needs to be dealt with. Okay, I don't want to give my employees shares in company because I don't want them to receive dividends or vote, but I want to give them the sense of ownership. Which one's better? So consider share options. Okay, so I've answered a few questions. Helen, do you want to have a look?
Yeah, I mean, another way is, Jack, you did mention it earlier when you spoke about loan plans, is issuing shares with a different class. Obviously, there needs to be changes from the corporate perspective in your shareholders agreement and constitution. That is one way to potentially issue equity to employees, but without them receiving dividends or voting, but they're still a shareholder. So that's something to consider as well. Some of these questions, so regarding premium option plans, the premium of 100% of current market value is unrealistic for established businesses. Are there alternatives to how this is structured? So as I mentioned, the premium option plan may not be appropriate if that is the case, because the market value could be significant. The benefit in having a premium option plan under an arrangement where the business is established and the market value is quite high is that employee does not have to actually exercise if there's going to be a drop in the company at a future time. The idea with the premium option plan is that you're wanting your employees to actually exercise when the company has grown to a particular value that's significantly higher than this premium that they're paying. If that's not going to be an incentive, then the premium option plan may not be the scheme that you want. So then you would have to speak with your advisor as to what are the alternatives. Next question is regarding indeterminate rights or phantom share schemes. Can an employee be promised cash or shares in the future, for example, based on revenue or profit milestones, and work full-time for free, or do minimum award entitlements to apply? So there are kind of two issues here, because employment law under the Fair Work Act, it's something you do need to consider when issuing share plans. In most cases, when we see these kind of alternative schemes, it is when the employee the scheme itself is giving them a bonus as opposed to paying their wages. Under the Fair Work Act, you still have to pay your employees the minimum entitlements, and it cannot be by way of equity. It has to be in cash. So unfortunately, these schemes are not to replace the minimum entitlements, and you can't use these as an incentive to, I guess, get someone to work for you for free with the incentive that's something we paid out in the future. So that's probably dealing with that second part of that question. But indeterminate rights and phantom share schemes, yes, the employee can be promised cash or shares in the future based on revenue or profit milestones. That's kind of the main purpose of these two types of schemes. I guess the other questions we've got are really about which scheme is more appropriate in certain circumstances. I think for those questions and the people that have asked those questions, it's really something, booking a call with either Jack or myself, and we can talk about your individual circumstances, and we can, weigh up the pros and cons and kind of guide you towards what is the most appropriate, and then we can go from there, because it's really hard to say one scheme fits into a particular scenario. It just doesn't work that way. There are so many factors that have to be taken into consideration. So was there any other points you wanted to raise, Jack, before we finish off?
No. Yeah, probably. I will say one point is that a successful share scheme is something that considers the commercial, the tax, and the legal considerations. Yeah. So that's the holy trinity from my perspective.
Yeah, definitely. People do think tax is the most important, but you have to have a scheme that actually works from a commercial and practical perspective as well. Taxes shouldn't be the only consideration that's taken into account. when putting in these schemes. So yeah, I definitely agree, Jack. Great. Well, thank you, everyone. We do really appreciate all the time that you've given us and appreciate that you've stayed on because it's gone over. Now, if you could please complete the 30-second survey that's popped up. Please include your contact details to receive a complimentary legal consultation, and we can discuss how we can help you with either your legal needs or one of these alternative schemes or anything else that you want to discuss. Thank you so much for joining us.
Thanks all. Thanks, Helen.
Thanks, Jack. See you later.
Bye-bye.